Hi, good evening, and welcome to each one of you all who have joined us today. Thank you for taking your time off to attend this session. My name is Vivian. I'm the senior market consultant at Century. I would be doing the technical analysis for today's session. What we'll be covering today is mostly Fibonacci and trying to identify trends in the market, and most importantly, how to manage your positions, how to identify good entry points in the market, where do you keep stop losses, where do you keep take profits, the risk management, how much to invest, and these are the key things that Fibonacci will help us identify and help us to also manage the investments that you will be investing into. So let's move forward and get into the topic today. Before that, at the end of the session, if you like the session that I've conducted today, if you have any reviews, if you have any feedbacks, please feel free to go to Google review and put as a review over there. At the end of the session, you can also put in all your comments and your suggestions as well as your feedback for my session on the chat box as well. If you have any questions during the session, please feel free to ask me questions, and I will try and answer as many questions as possible. All right. So, what is technical analysis? So, if you're a very, very new trader, do not worry about it. If you are already a trader for quite some time, have some experience in trading, it is going to be much of knowledge to you as well. And hopefully, this session will give you more technical insights into the experience that you already have. And for the ones who are very, very new to technical analysis or very new to trading or investing, do not worry, the session is going to be very, very simple to understand. And like I mentioned, if you have any questions at any given point in time, please put it in the Q&A and I will try and answer as many questions as possible. So coming to technical analysis. Now, there are two types of analysis that people do. One is the fundamental analysis, the other one is the technical analysis. So, what is the main difference between fundamental analysis and technical analysis? In very short term, fundamental analysis is everything that you do to understand the fundamentals of a company. For example, if you're looking Apple as a stock, you would like to learn what Apple does, what kind of product do they produce, what kind of revenue have they been making, how many years have they been in the market, and what are their quarter on quarter revenues. So these are the fundamental analysis that a person does to identify if Apple is a good stock to be invested in or able to trade. But mostly an investor, not a trader, would look at a company like Apple. A trader would probably not go in depth analysis of fundamental analysis of a stock, whereas a long term investor would always do in depth analysis of the stock that they want to invest in. Now, coming to technical analysis. Technical analysis is something that a lot of traders do, and less a number of investors get into technical analysis. But however, it will cater to both type of investors or traders. Technical analysis is nothing but it gives you the analysis based on past historical price movement. So basically, it is a trading discipline employed by a lot of traders to identify trends in the market, similar trends, similar price action that has happened over and over again in the past. And this is what technical analysis helps us achieve. Most importantly, technical analysis helps us to understand what is a good level for an investor or a trader to be entering into the market. At the same time, more importantly, the risk management. Even if they do have a signal or even if they do have the technical analysis that have shown that the market has always bounced back from a particular price 100 times over, it still gives us tells us where we need to keep a risk management no matter how many times it has worked back in the past. Moving forward, before I get into Fibonacci, I would want to get into one of the technical indicator that you can use while using Fibonacci, and that indicator is your average true range. Very simple to understand. ATR is it tells you how many dollars or how many points or how many pips can a specific instrument move. For example, taking Apple as an instrument, if I want to understand how many dollars does Apple move in a single day, I can either do it manually by looking at the price action, okay, or you can use this technical tool which automatically calculates for you how many dollars on an average can Apple move in a single day. Now, if I want to look at how many dollars can Apple move in a month, I can change the time frame of my chart to a month and it will show me the ATR, that is average true range. It will show me how many dollars can Apple move in a single month. And why is how many dollars can Apple move so important to us? It is very, very, very important to us because we need to understand, if I'm a day trader, I need to understand how many dollars can Apple move in a day. For example, let's say there's a stock that moves $5 a day. Now, when you look at the chart for the first time during the day, if the stock has already moved $5 for the day, you understand the moment, the average moment expected in that particular stock has already been done. So you would avoid doing any trades unless you have a contra view in the market. So this is how ATR helps you, and it is very important, especially when it comes to risk management. It will always tell you how many dollars of stop loss you should be ideally keeping. Now, again, giving you the same example of a stock that can move $5 a day. Let's say the stock has actually come down $5 a day. Now we can expect probably the stock to move back up by $5. But in the same scenario, you're not going to take a trade only based on ATR. You are going to look at what is currently happening for the stock in terms of fundamentals, news. Is there a news that has come out where the stock has dropped by $5? One. Second, if it is a normal correction in the market, and market can always correct itself even when there is no negative news, and it is perfectly normal in market, and those corrections are opportunities for people to enter into the markets. Now ATR again for this $5 stock would very simply tell me that if I'm going to be keeping a target or if I'm going to be keeping a stop loss, I should be looking at keeping a stop loss of minimum $5, and probably I can target a $5 1 is to 1 risk reward, or probably have a 1 is to 2 risk reward where I can keep my take profit or my target price $10 higher. And that is where ATR is going to help us. Now, very quick view of how it looks on our platform. If you have never used this platform, it is the most user friendly platform I have used, and I'm sure that once you get your hands on to the platform, it is easy for you to go through it, navigate as well. If you need any assistance, our team is there to always help you and guide you through it. Now, this is a chart of S&P 500. Now, S&P 500 is the top 500 stocks of US. It is an index, basically top 500 stocks put into one basket. Now, for someone who's looking to buy the top 500 stocks or the top 10 stocks of US, can individually go and buy those top 500 stocks, or they can just buy the basket as a whole as one unit. Sorry. So this is how the chart looks, and the bottom part, what you look at over here, is the ATR. Let me show you on another screen how an ATR looks. All right. So now I have gold right in front of me. I can click on, let's say I'm looking at a daily chart, or let's say I'm looking at a monthly chart. I hope a lot of you are following gold, and if you are, this could help you. Now let's say in a month, I'm just going to make this a normal candlestick. I will get into technicalities of the chart a little bit later, but let's just understand how ATR works. Now, if I'm looking at a monthly time frame, so I'm looking at all the way from 2021 till today, till April. I can go to my technicals, I can go to studies. Okay. Your options are technicals, then you go to studies, and your first option is your ATR. I'm going to click on ATR. ATR opens at the bottom. Now, as you can see, the ATR is telling me that gold can move about $120 a month. Okay. Now, of course, if you're not an investor, you're not looking at a very long term time frame, you might be looking at probably a short term time frame. and you want to understand how many dollars can gold move in a single day. So you just change your time frame to a day. Now we understand gold can move about $27 a day, right? Now, of course, if you're a very short-term trader or a swing trader, you might want to look at 30 minutes, and it tells you in 30 minutes gold moves about roughly $4. So if you're someone who's trying to capture smaller movements and you want to take advantage of the short-term momentum in the market, you would be looking at a 30-minute time frame or a 1 hour time frame. But if you are someone who is a long-term trader, or let's say probably a month or so, you might look at a daily candlestick, and on a daily time frame it shows it moves about $27. And you can also look at weekly just to understand in a week how many dollars can gold move, so pretty much about $60. So I hope ATR is clear over here. If you have any questions on ATR, please feel free to ask me. Let's get back to the presentation. Now going forward, basically this is the same ATR which I just showed you on the live chart. I'm just skipping through all the different time frames. Now, coming to the most important or most exciting topic of the day, Fibonacci. Fibonacci, the name itself sounds very magical. Uh, it is also to an extent, but a person who is very familiar with Fibonacci would understand that it is not as easy as it looks, but at the same time, it is very simple if you just follow by the rules. So let's look at what Fibonacci is. Fibonacci is nothing but a series of numbers. I'm sure you, all of us have learned this in our school. Probably some of us have forgotten about it, but then I'll just brief you all through it. It starts with 0 and 1, and you add 0 plus 1, you get 1, you add 1 plus 1, you get 2, 1 plus 2, 3, 2 plus 3, 5, and it goes on to infinite. There is no stopping to the Fibonacci series. But why is Fibonacci series important to us? Do we see a stock move in such fashion? No, we do not. We only look at the market. If you look at any market movement, nobody talks about how many dollars a stock moved. Nobody talks about how many dollars a stock dropped. Everyone talks about percentages. So these absolute numbers is not going to help us to identify anything in the financial markets, but the percentage that we can derive from this is what is going to help us. So let me move forward. I hope all of you all now understand how Fibonacci series work. Very simple. It starts with 0 plus 1. You add your first number with your second number, and it goes on to infinite. Okay, fun fact over here, Fibonacci sequence, also known as the golden ratio, appears a lot in nature. Patterns such as spirals of shells, curve of shell waves, sea heads, pine cones, branches of trees, all of these have the same mathematical sequence, and hence Fibonacci looks magical. The fact that things as large as spirals of galaxies and as small as a DNA follow the golden ratio rules, that Fibonacci sequence is there for. So pretty much everything that is fundamentally around us, we see the Fibonacci ratio. And I'll show you a couple of examples. Let's look at a geometrical representation of this Fibonacci. It's very tiny, probably on your screen, but it starts with 1 plus 1. It makes 2 square, 2 plus 3, 4, sorry, 2 plus 3, 5, 5 plus 8, 13, 13 plus 21, 34, and so on. It goes on to infinite. Now, if you connect all the dots of the corners of the boxes, you get a spiral, right? So if you notice any pine cones, or if you look at the waves that comes in sea or the ocean, you see similar patterns appearing. And when you actually measure these patterns, they fall into the same geometrical representation. It is very interesting. I would still encourage you all to go and do a lot more research or watch a lot of videos on Fibonacci. It is very interesting to know, how Fibonacci numbers appears everywhere. Now, this is a tree. Very simple example. The trunk of the tree is one single trunk divided into two branches, and then it divides itself automatically. Now, there's a fun fact over here also that I think if you have a small plant at home, you should try and count the number of healthy leaves that is there, not the leaf that is dying. Most likely on every stem or a branch, you would find either there are three leaves, or there are five leaves, or there are eight leaves. So even the plants follow the Fibonacci series, right? So that is the example of a tree, and the whole reason why the tree branches out in these series is the reason behind this is because if the sunlight has to hit every leaf of the plant, they have to spread out, and the most efficient way for them to spread out is in these series, and hence again Fibonacci appears over here. Now, Fibonacci numbers in nature, if you look at this very tiny spirals, of course, I could not microscope it in to do the mathematics behind it, but then it also has Fibonacci in it. More so, an entire galaxy has Fibonacci in it. If you can see it, I think you should be able to. If you cannot, then here is the geometrical representation that I had shown you earlier, and you see Fibonacci appearing here. Now, although all of this look very magical, you must be wondering why am I talking about so much of Fibonacci numbers and it has nothing to do with the stock markets. Now, I'll come back to the markets where we can look at identifying opportunities. Now that we understood how Fibonacci works, let's see why it is very, very important. Now, the key Fibonacci ratio is 61.8, also referred to as the golden ratio. How did we get 61.8? It is very, very simple. You take the first number from the series and divide it by the second number, and you should get 61.8, of course, multiplied by 100. Let's just go back to the series. If you all have a calculator or your mobile phone right in front of you, you can do this activity very quickly. Let's just take about 2 minutes to do this. All right. So the idea is you take your first number and divide it with the second number. It does not matter which number. You can take 2584 divided by 4181 into 100. Right. I'm guessing that all of you all are doing this. So I'll give you a minute or two. You all can respond to me back in the Q&A as well. If you're not getting the right number, you can mention that as well in the Q&A. Let's take a bigger number. Let's take probably 28657 divided by 46368 into 100. So I'm guessing most of you must be getting the right answer. It is 61.8, and hence the golden ratio. So irrespective of the numbers, the series in the numbers of the Fibonacci ratio, in the Fibonacci series, you divide any number, the first number with your second number, you always get 61.8. However, don't try doing it with a very smaller number because you'll hardly get the fraction out of it. Probably you start with 144 divided by 233, you should start getting 61.8. And the bigger the number it comes, 61.8 becomes more and more clearer to you. So now that is known as the golden ratio. Now, one point that I had mentioned to you was when we look at the markets, nobody or most analysts do not talk about how many dollars did Apple go up by today or how many dollars did gold go up by today. Everyone talks about the percentage, and this is where 61.8 comes into play when we start looking to identify market opportunities. Now, before I head out and show you few examples of 61.8 on the live charts, let me give you a couple of examples. Probably you can keep this in mind while I'm drawing the patterns or while I'm drawing Fibonacci on the charts. So, for example, let's take a look at my height. Let's say, for example, sake, my height from my toe till my head is 100 centimeter, right? Now, if you again, Fibonacci appears even in your human body. A fun fact that I would tell you is if you measure the length of your hand all the way from your arm till your tip of your finger, your elbow is exactly 61.8 percentage of your entire length, right? This again fun fact. You can try this at home, probably try it on different people. It will still most likely come down to 61.8, and it is crucial. Why is the elbow at 61.8% length compared to the rest of your arm? Because your hand helps you lift stuff, so you need to have a longer forearm with your wrist and your hands to lift things. So everything is designed in such a way. Now I give you this example. The second example that I would give you is my height, from my toe to my head. Now where does 61.8 end? It ends at my hip. So when I'm drawing charts or when I'm talking about any market movement, let's say market rallied from $10 to $20, for example. Now that is 100% move. Okay, and now we see the market again starts to come back down. Now I need to understand if the market moved from 10 to 20, that is the height of the body of the rally. Now I need to understand where does the 61.8 come for this 10 to $20, the 100% rally that has happened, and that is where you start finding opportunities. Now once I start giving you examples, will be more clear for you. Let me move forward and show you a couple of examples on the charts. I hope all of you all, it is visible for all of you all to see the chart clearly. All right, all right. I think the screen is a little small. Let me go to the live screen and show you all from the live screen. Perfect. If you all have any questions in the meanwhile, please feel free to keep putting your questions and I will try and answer as much as possible. Let's look at one of the most popular stock, Apple. I've just opened Apple. I'm just going to make this a daily chart. So we see a lot of swings in Apple, right? We see there was an upswing, then there's a downtrend, then there's an uptrend, then there's a downtrend. Now think of the example that I gave you, like my height, for example. So every time there is a new beginning of an uptrend, for example, just mark this over here. Let's say a downtrend completed at this level. Eventually, after Apple moved significantly this high, we know the uptrend has begun, and at this point we understand the uptrend has ended. Now this becomes the entire body. All right. So you can also look at this particular rally over here. The market rallied up from here, went up, then you saw a downtrend. Now, assuming this is my body, right? Now I want to understand where is 61.8? Where does it come back to help me support this particular rally? So this is where you go to your technicals, so you go to your draw tools, you find Fibonacci here. Now I'm going to click on Fibonacci. Keep in mind, you always measure Fibonacci to a rally or a downside. For example, you catch the lowest point to the highest point. Okay, the significant lowest point to the significant highest point, because the market will have a lot of low points and the market also will have a lot of high points, but the significant one, I will explain what a significant one means with the current momentum in the market. The last rally that has happened, it took off from here, okay, and it ended here. So what is my significant downside at this point in time is this is the last low that I've seen, although we are seeing a new low happening right now, but this is still in play. I'm looking at the previous low that has happened and the previous high, and when I draw my Fibonacci, I'm always going to choose my lowest point to my highest point, right? If you all have any questions on how to measure Fibonacci, you always choose your significant rally, okay, or the significant move, you can call it, because Fibonacci also can be measured when the market crashes. Wherever you see a significant move, you catch the beginning of the move and you end at the finish of the move. In this case, the move began here, okay, and the move has ended here. Now, most of you all must be wondering, why am I not considering a move that has began here and which is still here? I will not consider this as the end because the market still has not started recovering. Probably this downside could continue going down. I will wait for a reversal in the market, and that is when this is the place where the move began, And wherever this ends and it starts recovering, that will be the place where the move ends. So I hope I'm clear with this. Now let's look at Apple on a monthly time frame. Always do your analysis, or if you're a very new beginner, always try and do it on a larger time frame before getting into a shorter time frame, because shorter time frame has a lot of noise. Whereas your larger time frame, if you look at these particular candles, there's Apple all the way from 2009 till here. You can see a smooth flow, right? And one tip that I would mention, I'm not covering the topic for this today. The candlestick that I personally prefer would be not the normal candlestick. I always prefer Hikanashi. The difference between these two is very simple. The normal candlestick just shows you if the market closed higher or lower on every candlestick. If the market opened and closed lower, it becomes a red candle. If the market closes higher, it becomes a green candle. Whereas if I select Hikanashi, just keep your eye on these candles here. The minute I click on Hikanashi, you see it's either a series of red candle or a series of green candle. So how does this help me? It helps me identify a trend, or it helps me identify when a trend has ended or it is starting to end. Now let's look at the past and see what has happened. Now, remember the place where I said significant rally, right? So I can see couple of places where we saw steep rally that has happened. There's one. I can see another rally that took off from these levels. I can see another rally that took off from these levels, right? So now these are my significant points. Now let's draw Fibonacci and see how did, or if 61.8 made any difference. Okay, now we understood how to draw Fibonacci. Now I'm going to show you. Let me just try and zoom this in. Okay, perfect. Right? It's more bigger. Now I understand my drawing of my Fibonacci starts with a significant beginning and ends at a significant top in this case. Now let's look at what has happened on Fibonacci. Remember the series that I gave you, 0, 1, 3, 5, 8. We derived 61.8 by dividing my first number with the second number, and that came out to be 61.8. Do not pay attention to 23, 38, 50 for now. Let's just look at 61.8, which is here. I'll try and make this bigger so it's, I think this perfect. Right? So you can see 61.8. Let me remove the rest. We do not need these now, but however, I'll tell you how 38.2 is calculated or 23.6 is calculated. For now, we are just looking at the golden ratio. And yeah, so let's look at what has happened here. Market rallied, and then there's a turn around in the market. Market comes back down to a point over here, and the market continues rallying, right? It stopped at a point and it starts rallying back up. Now, using your Fibonacci ratio, we always learned that, or using Fibonacci, we always understood that there is always a crucial point or a crucial time that things happen, or in a certain way things appear to be. So, hence 61.8 over here could be one of the reason why the market would have gone back up. Now, again, disclaimer over here is not every single time the market drops back down, it comes to 61.8 and jumps back again from 61.8. If life was that easy, I think all of us would be millionaires by now. But this is just one of the tool, and this is just one of the indicator that every technical indicator or every technical analyst or every technical investor or trader looks at to understand when to start buying back. Now, apart from that, let's just think of something more logically over here. Apple was trading at $23, right? Apple went all the way to $58, and Apple drops to $36. Now, Apple in this particular rally, it rallied, if I do percentage, it rallied up by almost 162%, okay, and then gives a drop of almost 38%. Now you're getting the same price of Apple. Instead of paying $58 for it, you're getting a 40% discount on it. So if you look at it practically or logically, to buy back Apple, you would always wait for Apple to give you a drop and then buy back. So that is one of the logical way to look at percentage wise. But in terms of using technical indicators, Fibonacci gives you that. Now let's look at the immediate next rally that has happened. Okay, now we see there was a rally that has begun from here, ended here. You can also take this bottom. Okay, now I just zoom this in. Right? So you see the market has gone up, market drops back down, comes to a certain level and bounces back up. Now in this case, again, the market went all the way from $35, the previous Fibonacci support. It went all the way to $80 now, and it has come back to $50. So now if you see, in terms of percentage, you're again getting a discount price to buy. So at any given point of time, probably the market might never come back to the same price it was at one point in time, because the market always keeps growing and market always keeps going towards the upside if it's a growth stock, right? Now in this case, Apple again from here rallied quite a bit up. Over here we did not get any drop, so no opportunity there. It is moved from here to here, couple of opportunities, but it still did not come back to 61.8. Now let's do a very small activity and a very quick one. If you have any other, now I've chosen Apple. Okay, I could be biased. Do you want to choose any instrument? Again, like I told you, not everything has to stop at 61.8, but we can test couple of couple of stocks or couple of commodities. Let's look at a commodity. If you have anything, please put it in the suggestion and we'll do that. All right. I think majority is for gold. Okay, let's look at gold. I'll just open new chart here. And here we have gold. I'm going to go into the longer time frame for now to smoothen things out. If we look at shorter time frame, there's a lot of swings. It's going to be difficult. So I'll show you short term as well. Again, there's my 1 month chart, changing my candle pattern to Fibonacci. Now you can see it's more smoother. It's more easy to identify where a rally began from. Okay, now let's look at the biggest rally that has happened. Pretty much, it happened all the way from 2005, but then we saw a steep correction over here, right? And then we see a big rally. So a good momentum here. Let me measure this momentum. Market has gone from here till here. If you look at it, I think gold was trading around 680 at that point of time. Gold went all the way up to 19. Oh, sorry. Let me make this as accurate as possible. Yeah, about 1890, and then the market started dropping back down again. Now, in this case, investor, because if I'm looking at a monthly time frame, I'm more of an investor than a trader. I'm more interested in buying and holding for a very long period of time. Now, I definitely would have missed this rally, but I want to get back into gold. Let's say I'm a very new investor and I wanted to start probably investing in 2011. Now, this would have been a very, very bad time to actually buy and hold for long term. For short term traders, yes, there could have been a lot of opportunities on a shorter time frame. But as a long term trader or an investor, would this be a good time to buy? No. But if the prices drop back down, it would be a much better price for me to buy, and that is where I make my profit. So in this case, if I had to follow the rule of Fibonacci, I would wait for it to come back to 61.8 and buy it. And let's see what has happened. It came down, it hung around at 61.8, I think, for almost all the way from 2014, 16, 18, and then it bounced back up, right? So now you know why I said for a long-term investor, because anyone who looks at a monthly chart is always more towards a long-term investor. So anyone who would have bought at this price would not have jumped out of the trade immediately. They would have waited for it to give a significant move and come out of it. Now coming to what do we do with gold today? As an investor, again, not as a trader, gold has rallied pretty much from here to here. It tried coming back down towards 61.8. It did not. So hence I will not do any sort of long term investment on gold at this point in time. Right now, probably there are views that a lot of banks or big banks or a lot of big analysts who are giving, who are suggesting that gold could possibly go to 2,400, 2,200, 2,100, and uh, the levels on the higher end. If that happens, not an issue. As an investor, I would still follow the rules. If I'm doing Fibonacci is going to be my indicator, I'm going to follow the rules of Fibonacci. Let's say gold goes to 2,400. Let it go till 2,400. But I would wait for it to come back to my 61.8 so that I can buy it at a very discounted price. Now, I hope all of this has been useful and it is easy to understand. I'll try and do a couple of live trades, or I will try and do a couple of live. I will try and identify some live patterns or these Fibonacci's on a shorter time frame. So what happens is a long-term trader might have to wait for a year or two before he gets onto gold, or in the current market momentum it might end up coming even within next 6 months. So we cannot time the markets, we can always anticipate based on the historical moment that has happened. Now I'm just going to get back to my presentation, and then we will come to the charts and we will look at how do we use Fibonacci and how do we place trades, where should you be keeping your stop losses, and where should you be keeping your take profit. Just 1 minute. I'm just trying to change my screen. All right. So now I've covered what Fibonacci is. I hope all of you are very familiar with how the Fibonacci series work. Now, most of you all will know how the ratio of 61.8, which is the golden ratio, is derived from the Fibonacci series numbers. Now, using Fibonacci does not stop only at 61.8. Like I mentioned to you, there is 38.6, there are 88.6, there is 78.6. How do these numbers appear? Very simple. You can divide your, when you divided your first number with your second number, you got 61.8. You divide your first number with your third number, or the third number, you should get 38.2, and it goes on. Now if you do a square root of 61.8, you will get 78.6, and if you do a square root of 38.6, you will get 88.6. Root square of 78.6, you will get 88.6. Now these are the numbers that is being followed universally, and these are the levels that we always look at to identify opportunities as well as to identify potential targets and stop losses, which is our risk management in case 61 point does not work. Like I told you, 61.8 is not that magical that it works every single time. So we need to have risk management at all times. Now, using Fibonacci, now we understood we have 61.8, we have 38.6, we have 50%. 50% is not a Fibonacci number. 50% is pretty much 50% of the entire rally or the entire movement that has happened. But again, since a lot of technical analysts consider 50% also as a crucial or a good level of price to be looked at, as 50% also has been included while we do the Fibonacci patterns. Now, harmonic patterns is something that is derived using Fibonacci ratios. To make it very very simple, I will just jump into a diagram. Okay, according to Gartley, so Gartley was the first person who identified this pattern. So the traditional pattern is known as Gartley, bullish Gartley if you're expecting the prices to go up, bearish Gartley if we are expecting the prices to go down. So bullish always means upside, bearish always means downside, and of course, eventually Scott Carney invented other patterns and they named it after animals because some of them actually do look like the butterfly, do look like a bat, do look like a crab. Now, how does Fibonacci help us? What and when to buy or sell? Of course, it does not stop there. Even if you understand when to buy or sell, we need to keep our stop losses and take profit, but it helps us identify opportunities in short. Now, this is how a Gartley pattern looks. Let me just explain this on the screen. Okay, so a pattern, remember I said significant high, significant low. Please always keep that in mind when I'm giving you an example, and also always keep in mind my height. So we are trying to identify a person's height or the length of a movement that has happened in the market to identify where the crucial point comes back, where the markets can rebound. Let's look at bullish Gartley for now. X is the point where the rally began, or where the price of, let's say, gold started moving up. For example, looking at gold, gold started moving up from point X, it went till point A. Probably 3 months later, we found out gold is starting to drop, so I identify it has started to reverse. 6 months later or a year later, gold has dropped further, so this has become a reversal zone. It comes down to point B before it starts going back up again. Now X, A, and B has to come back to 61.8. So when I measure X and A, I will measure point A, point B, or I'll use my Fibonacci to measure my starting point to the ending point of the rally. And if it comes to 61.8, that is one signal that a potential pattern is in formation. But of course, one does not cut it. We need to have at least four signals for us to get a proper pattern in the market. I will show you an example that we had recently got one. I think it was on the 14th of this month. I will show you how the pattern looked and how the pattern also worked out eventually. Now it came down. So then I measure point starting point to my lower point. It has to reverse back up. So basically, the Fibonacci reversal, if I measure A and B, should come back either to 38.2 or 88.6 or in between, which is the 61.8. And in this case, most likely it is 61.8 before we saw the reversal back down. Now, why is this pattern recognized, or why is this pattern important, or why did this pattern become that significant to Mr. Gartley? Is because every time he saw this pattern happening in the market, it always gave him a signal of buy. So, bullish is buy signal. Bearish is the opposite of what we just saw, but let's just look at one direction for now. Now, most likely, every time a pattern is formed and it forms exactly on these Fibonacci ratios, most likely the trade is expected to go in your favor. In the probability wise, it might be a higher probability trade. That is the one advantage of the pattern. Second advantage of the pattern is your stop loss is going to be very close, meaning your risk reward can be sometimes even 1 is to 5. Okay, most of the time it is 1 is to 2, 1 is to 3. But in certain cases, when you're looking at a longer time frame, probably you're looking at a weekly chart and you find a pattern. Now, on that, probably your risk reward can also go up to 1 is to 10. Meaning, if you risk $100, you might make $1,000. Or you risk $10,000, you would end up making $100,000. Provided all of these fall in line with the market. Now, just to show you the other patterns, so bearish is completely opposite of bullish. It's vice versa. You measure top to bottom. We used to measure bottom to top. Now we look at drops in the market. Let's not get into that. As long as we understand how to draw Fibonacci and how to find a ratios for now is good enough. This is a bullish bat. The only difference between a Gartley and a bat is Gartley comes and ends at 61.8, whereas a bullish bat has to end between 38.2 or 50%. Okay, so the percentage or the numbers on the Fibonacci changes. That's the only difference, and that's the only difference they have, and it's been named differently. In terms of the logic, it is still the same. Now, bullish crab. Now, crab usually have long legs, so if you can keep that in mind, we understand why this is called a crab. It always extends more than what was anticipated. And when these kind of patterns happen, which is again, if you look at bat, it has to end at 261.8 or 88.6. But if you look at bullish crab, it is 161.8 or 361.8. So it is extended more. So when these patterns appear, now these patterns are also very good risk reward trades, but it happens over a long period of time. Bullish butterfly, again, probably it looks like a butterfly. So it's been named butterfly, but again, the only difference between all of these patterns are how you measure them and what points are being connected. So, coming back to our live chart, if we have any other questions, please drop in the Q&A section. I will try and answer. I'm guessing nobody's asked me any questions so far. I hope I've been clear so far. All right. So, I will just show one of the patterns that had appeared recently, and then move into how to take trades using Fibonacci. To understand identifying harmonic pattern or to get signals after you identify harmonic patterns, do not worry if you do not get it in the beginning. This is still a very foundational course, and you can get much more knowledge from your consultant. You can reach out to your relationship manager and tell them that you want more training on these. Our consultants are always there to help you and equip you more. But if you do not have time, or if you want someone else to identify for you and let you know when such a pattern occurs, you may also get in touch with our consultants or your relationship managers. And every time a pattern appears, they will notify you, and then you can use those notifications to make your investment decision. Now, coming to S&P 500, I'm just going to go on a 30-minute time frame. Right, lot of movement has happened. The trade that I had identified, or the harmonic pattern that I identified, was on the 14th, 13th of April actually. We are on the 12th. I'm looking at a 30-minute time frame, so each of these candles represent 30-minute movement only. Again, just to make this clear, these are your normal candlesticks. I'm just using Fibonacci to make it more smoother for me. Right, now this was one of the patterns that had formed. So top to bottom. Okay, I'm measuring top to bottom. Now I'm looking at a bearish Gartley or bearish bat. In this case it was a bearish bat because if you notice, market came down, market reversed. It did not go to 61.8. It went and it stopped at 50%, and hence it is not a Gartley pattern. Now once these points have happened, you can mark it. I'm just going to mark this. X, A, and B has been formed. Now we need to make sure even C and D is formed before I take a investment decision or a trading decision. Now let's look at, okay, I'm just going to draw this from the beginning. First we measure top to bottom. Now I'm going to measure bottom to top, right? In this case, it has to come anywhere between 61.8 and 88.6, to which it has come almost close to 88.6. Okay, this becomes my C point, but most importantly is your D point. D point should always, I will just close this. So now we have X, A, B, C. Fibonacci, now we measured bottom to top. Now top to bottom again, and my D point ends at 161.8. Okay, again, above 100% is your 161.8. Golden ratio is still 61.8. About 200% move, for example, let's say market moves about 200%, then you look at 261.8. In this case, it has come to 161.8 at this price. So we formed X, A, B, B, C, and D. Now, this is a bearish pattern that I showed you on the chart earlier. Now, in this case, let's look at a risk reward if I'm going to take a trade on this chart. So, I'm short selling. For those of you who are not very familiar with short selling means you're expecting the prices to come down. So, you stop buying, you short sell directly. Let's not get into the integrities of what short selling is. It's a very long topic. It would be much better for me to explain that in person. But for now, just leave what short selling is out of your mind. Just understand, if the prices drop, you make money. If the prices go up, you lose money in this case. So what I'm going to be doing is I'm going to be taking a short sell at 4457, 4457, right? So you can see the orange line here. If I'm going to short sell here, let's say I have $10,000 in my account. I'll come back to the number of units later. Now I need to identify stop loss. Where do I keep my stop loss? I need to keep my stop loss above the pattern. So your stop loss is very clear. You keep your stop loss above the pattern. So you have X, A, B, C, D is complete. So you're taking a decision to sell the market over here, and you're going to keep your stop loss above the pattern, right? Now, where do you keep your take profit? I will show you later where you can keep your take profit. It will always be on 61.8 back downwards. So there's roughly it's going to come up here. There are a lot of lines. I'm not going to draw the target right now. For us, most importantly is the stop loss. Once you have stop loss, your risk is under control. Your profit is up to you. You wait till the target. Always wait for the target. That is when you will be a successful trader. Or you can also extend your targets as and when you feel like. But stop loss is something once you set, you never remove. Okay, now let's say I have $10,000. I invest $10,000 right now. In this case, I'm going to be risking $36 to make about $100 profit. Okay, which is decent for a $10,000 account. Now, let's say if I'm someone who has a bigger risk appetite, I don't mind taking a bigger risk. So I can still take a trade worth $100,000. Again, do not take leverage trades without understanding leverage, because now I'm investing 100,000, 10 times more than what I have in my account value. And this is the most riskiest trade that anybody could do, right? So whenever there's leverage, it is the most riskiest trade, and make sure you always keep stop losses if you do take a trade with leverage. Now in this case, I am taking $100,000 trade. I have a stop loss which is going to be again $360 to make a profit of $1,000. Still not bad risk reward. Okay. Now in this case, because I have my stop loss in place, I don't mind taking $100,000 trade. If I remove the stop loss, for example, okay, and then market starts going up, your losses, you might end up losing your entire capital, because eventually market can move wherever they want, right? We were looking at this particular pattern that appeared in this particular time frame. So make sure your risk is limited to that particular pattern for that particular time frame. It was a short term trade on a 30-minute chart. So probably your result could have come within 1 or 2 days, or sometimes within the next 30 minutes too. If that does not happen, you have your stop loss and you exit, right? So this is the harmonic pattern. Now let's make it a little more simpler. Let's leave the harmonic out for now. Let's look at the current markets. Now, can we use? Of course, we looked at drawing our harmonic patterns or drawing our Fibonacci on a very longer time frame. How about shorter time frame? Does it work on shorter time frames? Let's look at what is happening on SPX chart. Okay, so we can see a lot of swings. So, in my words, a lot of significant moves. Now, what has happened currently? What are the last two things that has happened currently? Is there was a big swing and there's a downswing. Now, this tells me, let me measure the big swing starting from here, and the downswing, right? Can start from here also, okay, because the momentum began over here. It depends. If you want to catch the exact momentum, this would be the right place. This also isn't wrong. It depends on traders to trader. Now I've identified this upward momentum, market has come down. What would I do at this price? Anyone on the chat can just drop in a message very quickly. Now I saw a rally, a significant move. Okay, this was the length of the rally. It has dropped back down. What would I do over here? Okay, I'm waiting for a couple more of answers. What does 61 point tell me? So you always wait for, you missed this rally. It came back down. It is at a much cheaper price compared to where it was here. So you get a buying opportunity, right? So let's put a trade. Now comes the most important thing, your take profit and your stop loss. Take profit is second, stop loss is always first. Okay, now like I mentioned to you, there are a lot of Fibonacci numbers. I'm just going to quickly put this here. 78.6, 88.6. I'm going to remove 23 and 38. We do not need it right now. 50% is also not required for now. All right. So I'm just going to do with 61.8, 78.6 and 88.6. So as an investor or trader on a 30-minute time frame, I'm more of a trader. I will take a buy at current price, but I'm going to keep my stop loss after 61.8 is 78.6. I'm going to keep my stop loss. My stop loss is fixed. Now I measure top to bottom. Okay, let me show this again. I measured bottom to top. Now I need to measure top to bottom to identify where 61.8 comes when it goes back up. So that is somewhere here. I'm gonna put my take profit there. Okay, perfect. Now let's look at my risk reward over here. So I'm risking about $130 to make about 190, 120 to make about 190. Decent risk reward. 1 is to 2 is always better. And I'm gonna take the trade. Perfect. So here's your trade on Fibonacci. While this trade happens, either it hits stop loss or take profit, I will just explain it to you. We have come to the end of the session, but I hope the session was easy for you all to understand. But at the same time, I hope all of you all got more knowledge, especially if you already had experience in trading. Uh, this trade, again, just to give you an example, market rallied from this point to this point. Okay, so I identify the market top has ended when at least 3 to 4 candles started coming downwards, right? That is when I measure my bottom to top to see where 61.8 comes and buy it at that price. So 61.8 is at 4227 roughly. I'm going to take a buy here. I'm going to keep my stop loss on the next Fibonacci number 78.6. Okay, and my take profit, which is very important. If you reverse this from here to here, my take profit will be at 61.8 when the market goes up. Let me just zoom this in, right? Okay, I'll just take the last minute because I did not cover ATR in the meanwhile. So let's just put ATR, studies ATR. Okay, perfect. So my ATR is telling me that S&P 500 or SPX 500 can move roughly $10. Okay, so I have taken a buy right now, correct? And I have taken a buy at 4229, almost 4230. Okay, and I've kept a take profit of 4248. Am I in line with the current market momentum? Yes, pretty much I am, because the ATR tells me every 30 minutes it can move $10 or $12. I've kept a $20 take profit, $19 to be precise, and a stop loss of $12, right? So now, without using my ATR, Fibonacci also helped me identify how many dollars your SPX 500 can move. But always combine your ATR with your Fibonacci to make sure that you have enough space. For example, I have enough space now in case the trade wants to go against me a little bit. I have enough space for it to again bounce back up. If I keep the stop loss too close, it might trigger my stop loss. If I keep my stop loss too far, then I'm risking $200 to make $200, which again is not worth it. There is It is 1:1. Your risk reward should always be 1:2, right? So, thank you all so much for joining today's session, and I hope it was very informative. Please do not forget to give us your review on Google. If you have any suggestions, any feedback for me, please feel free to write it in the chat or even in the Q&A. And I hope to look forward to speaking with you all in the next webinar again soon. Take care. God bless.